Welcome to The Explainer. So there's this really strange mystery hiding in plain sight in the financial markets. I mean, on the surface, everything looks fantastic, but underneath, something just feels off. Today, we're going to follow the clues and try to figure out what is really going on.
Okay, so let's just dive right in. On one hand, you've got the stock market, the S&P 500 just humming along near its all-time highs, right? Everything looks great. But then you look at this other thing, the CNN Fear and Greed Index, and it's flashing extreme fear. We're talking a 9 out of 100. 9. I mean, that's a level of panic you usually only see when the market is literally crashing. So what gives? What is causing this huge disconnect?
And that's really the central question for us today, right? What is the market so darn afraid of? To solve this puzzle, we've got to look for clues. And our investigation, it's going to start with the biggest, hottest name in tech right now, Nvidia.
Okay, so here's our first clue. On the surface, Nvidia's earnings look just spectacular. I mean, it seems like a massive win for the whole AI revolution. But, we have to ask, how is that money actually being made?
So they reported a staggering $57 billion in quarterly revenue. That just blew past all expectations, and you could feel this wave of relief wash over the entire AI sector. But, and this is a big but, if you look a little closer at that number, our mystery only gets deeper.
Yeah, you scratch just beneath that shiny $57 billion surface, and you find something a little concerning. It's a practice known as a circular financing scheme. Now, what does that mean? Well, put simply, it's a system where a company invests in its own customers, and then those customers turn around and use that exact same money to buy the company's products.
So let's look at how this Nvidia loop works in the real world. Step 1, Nvidia invests billions of dollars into its customers. You've heard of them like OpenAI and Coreweave. Step 2, those same customers then use those investment funds to buy Nvidia's chips. And then for the grand finale, Step 3, Nvidia gets to book all those purchases as massive revenue growth. You see, it creates this perfect, self-fueling loop that looks just like explosive organic demand. But the big question is it real?
And this whole thing led the famous investor Jim Chanos to ask a really pointed question. He said, "Isn't it a bit strange when the demand for compute is infinite, the sellers keep subsidizing the buyers?" I mean, think about that. If demand for your stuff is truly infinite, why on earth would you need to give your customers the money to buy it? It's a fantastic question, and it really gets to the heart of our first big clue.
All right, let's move on to our second clue. And this one comes from one of Nvidia's biggest customers, a company we just mentioned actually. You can think of them as the canary in the AI coal mine. That company is Coreweave, and these guys are a huge player in building out all the infrastructure for AI. But their stock has absolutely collapsed. We're talking a drop of over 50% in just a single month. And this is happening even though they're supposed to be one of the biggest winners of the whole AI boom. Bizarre, right? And this whole situation reveals what you could call the Coreweave paradox. I mean, look at the hype. 133% revenue growth, a massive $55.6 billion backlog of orders. Insane! But then you look at the reality, a $110 million net loss and almost $15 billion in debt. So how? How can a company with all this supposed demand be losing so much money and be so deep in debt?
It really raises a super serious question, and it's one that analyst Gil Luria highlighted when he called this whole model bad behavior. You have to wonder, if the poster child for AI infrastructure, the company that's supposed to be crushing it, can't turn a real, sustainable profit, then who can? Who in this entire space actually can? And that, right there, is our second huge clue.
Okay, for our third and final clue, we're going to zoom out from the corporate world and look at the people steering the entire economy. And what we're about to see is that, well, they're essentially flying blind. So, a recent 44-day government shutdown did something more than just delay a few economic reports. It literally created a permanent data black hole. All the critical reports for the entire month of October, we're talking inflation, unemployment, producer prices, they weren't just delayed, they were never collected. That data is just gone. Forever.
So, what are the consequences of that? Well, it means the Federal Reserve, the institution that sets interest rates for the entire world's largest economy, is now forced to make its critical December interest rate decision using data from September. That's information that is nearly 3 months old. Just let that sink in for a second.
Now, despite this massive, glaring hole in the data, Fed Chair Jerome Powell came out and publicly claimed, and I quote, we have sufficient data. Unsurprisingly, that's a statement that raised, well, more than a few eyebrows.
The source material we're looking at today has this brilliant analogy for the situation. It's like saying you have enough visibility to drive your car because you can see where you were 3 months ago. I mean, sure, that's great, but it tells you absolutely nothing about the giant cliff you might be about to drive off of right now. So, okay, we have our 3 clues: the Emperor's new chips, the canary that stopped singing, and this data black hole. How does it all solve our mystery? Let's connect the dots and figure out why the market is so scared, even while it's hitting all-time highs.
So when you put it all together, you get these 2 completely opposite stories fighting it out. In one corner, you've got the bulls. They're looking at the strong earnings from companies like Nvidia. They're pointing to the fact that the holiday season is usually great for stocks, and they're feeling good. But in the other corner, you have the bears, and they're seeing something totally different. They see crazy high valuations, those shaky circular financing schemes we just talked about, and a Federal Reserve that is trying to navigate, well, basically lost in an economic fog.
And all of a sudden, that extreme fear we saw at the very beginning, it starts to make perfect sense, doesn't it? It's not just some irrational panic. No, it's a completely rational response to these enormous hidden risks that the market's high prices seem to be totally ignoring. That fear, it's a recognition of the huge cracks hiding just beneath the surface.
And this leaves us with a final, pretty provocative thought from the source material. It's like this. The music is still playing at the party, for sure, but the DJ is starting to check his watch, and someone over in the corner just noticed that all the fire exits are blocked by server racks. The warning signs are everywhere. And maybe the real fear isn't just that the party will end. The real fear is that when everyone rushes for the exits all at once, they'll find there's no way out.